Ready to buy your dream home, but unsure how much you can afford? In this video, we're going to break down the key numbers you need to know to make a smart and confident decision. Welcome to the channel. My name is Blake Alewelt, founder of the Bravo Ridge Group at eXp Realty. This video is part 3 of a series of short videos as a complete guide to buying your next home. I'm going to simplify all the mumbo jumbo about what getting a mortgage looks like, from understanding your debt to income ratio to the down payment and closing costs. Let's break down what you need to know how much house you can afford. Let's get started. So knowing you want to buy a home is one thing. Knowing how much of a mortgage payment you can handle is quite another. Too often, we dream of a comfortable 4-bedroom colonial home, but given our income and credit card debt, the best monthly loan payment we can manage would be a 2-bedroom bungalow in a not-so-great part of town. So how do you pinpoint a house where your monthly mortgage payment makes sense and won't drive you deep into debt? This brings us to our first topic. Number 1, why your mortgage payment depends on your income. Getting a ballpark estimate of how much house you can afford starts with looking at your income, or how much money you're pulling in. The general rule of thumb is that you can purchase a home that costs 2 to 3 times your annual income. So if you and your wife are earning $100,000 per year and you have a reasonable amount of job security and don't expect any wild fluctuations anytime soon, you can afford a house up to 3 times that, or $300,000. That said, income isn't everything, and this is just a ballpark figure to get you started. Tripling your income is only an estimate and does not account for your monthly bills like your car payments or college debt, which brings us to our next topic. Why your mortgage payment depends on your income and debt. Your income is the only half the picture of what determines the monthly mortgage payment that you can afford. The other half is your debt, meaning the debt you owe to credit cards, college loans, auto loans, all of it. So even if your income is substantial, high credit card debt means you have less money available to put forward towards a monthly mortgage. One way to factor your income and credit card debt into how much mortgage you can afford is to follow the 28-36 rule, a simple but effective ratio for mortgage affordability. 28 refers to your monthly housing payment, things such as mortgage, home insurance, property taxes, which shouldn't be more than 28% of your gross monthly income. Ideally, this payment should be less. This payment is easy to calculate because all you need to do is multiply. For example, if your gross monthly income, meaning before taxes are taken out, is $6,000, you would multiply that by 28%, or 0.28, which equals $1,680. This is the maximum amount of your monthly housing payment. The 36 refers to your total debt to income ratio. This ratio compares your debts, including this potential home loan, to your income. This ratio should be no more than 36%, even though some lenders will allow 45%. Think about this ratio in terms of your monthly expenses. If you have a monthly income of $6,000, but also spend $500 each month paying off credit cards or other debt, you would divide $500 by $6,000 to get a debt to income ratio of 8.3%, which actually sounds great. However, adding in $1,680 in monthly mortgage payments would push your debt load up to $2,180 and your debt to income ratio to 36%, the maximum of what we talked about. Going past this threshold is a very risky move. Ignore this ratio and you could end up with something called house poor, meaning sure, you have a nice house, but unfortunately you don't have enough money left over each month for any fun activities like vacations or traveling. Now let's talk about the largest amount of money you may ever spend, the down payment. Number 3, how a down payment fits into the picture. The amount you have available for a down payment makes a big difference. Ideally, to get the best mortgage rates and terms, you'll want a down payment amounting to 20% of the price of the house. But thankfully, some great programs are available. You can bring much less to the table. Likely with FHA loans, for instance, you will only need a down payment of 3.5%. And there are 5% down conventional loans, or even 0% down VA and USDA loans. Just know with less money down comes a cheaper home because the monthly payments will be much higher and will be limited by that total debt to income ratio. For a sense of what's possible, if you put down your own numbers and locations into Realtor.com's home affordability calculator, you'll come away with a better sense of exactly how much you can afford to spend on a home. This next step is very important to solidify the price of the home you're able to buy. Number 4, the mortgage pre-approval. Another easy way to get a sense of how much you can comfortably pay in monthly mortgage payments is to approach a mortgage lender and apply for a mortgage pre-approval. The lender will take a look at your income, debt, credit score, credit report, and other factors of your financial past to determine how much money they're willing to loan you to buy a home. We highly recommend this approach because if we find a home that you would like to put an offer on, you'll have to go through this process anyway, and a lender may not approve you for the price of the home that you chose. As a bonus, pre-approvals also make you look more attractive as a buyer to home sellers, since they know you have financing to back up the offer. Number 5, beyond your mortgage payment, what else do you have to pay? In addition to your down payment and monthly mortgage payments, you'll want to budget for some other costs. These usually surprise people, so please remember these. The big one is closing costs, which are fees related to processing your loan. These costs can range from 1 to 5% of your home's price. Closing costs aren't paid monthly, but rather due at closing when you get your keys. So make sure to set aside enough money to cover this sizable expense. The other big ongoing expense to factor in your monthly budget is property taxes. Property taxes are often folded into the monthly payments you'll find in a mortgage calculator, but they're worth examining as a distinct factor since they vary greatly by area. So you'll want to check property taxes carefully. Plus, they will adjust once the sale is complete based on your new purchase price. You can typically find the estimated amount of property taxes you'll pay by entering in your address to an online home value estimator. Your realtor, whether it's myself or not, should also be discussing this with you as we are able to see exactly what the seller is paying currently before the sale. One final housing expense to keep in mind is homeowners or landlord insurance if you're going to rent the house. This is also factored into payment estimates made by Zillow or Realtor.com's mortgage calculators, but this payment will vary by area and home too. You can often break up this payment into small monthly installments, so you won't feel the pinch quite so much. This is also the cost that varies the most each year, so be sure to constantly get new quotes each year. I have a broker I use that just recently was able to save me 30% of my insurance by switching providers. Number 6, add it all together. So once you've determined how much you can afford as a monthly mortgage payment, we can confidently embark on your house hunt. Having a certain mortgage payment ceiling in mind based on your pre-approval means you won't end up busting your budget. You can choose a house that fits comfortably in your payment profile so you know you can handle the monthly bills with ease. If you find your monthly income and mortgage budget aren't enough to snag the type of home you want, you'll have to start weighing what you absolutely must have in your home and what you're willing to sacrifice. You can use what I call the pick 2 rule of thumb: payment, quality, location. Typically, you could prioritize 2 of those categories in a home, but not all 3. Your best bet is to stick to a great neighborhood for a monthly loan payment within your budget, and know that your home might not have that pool, the wine cellar, or other amenities that you'd hope for. These trade-offs are just the reality of scrounging together enough of a payment to manage a mortgage and a house without getting sucked deep into debt. If your monthly payments are falling short of your dream house, try widening your search to different neighborhoods or knocking a few items off your wish list until you find the location and amenities that fit you best. Weigh what really matters for your dream home and try to stay optimistic. Remember, you can always add an amenity later. With enough searching and some luck, you can find a dream house that not only has all the features you want, but also doesn't break the bank. And that wraps up part 3 of the complete guide to buying your next home. Don't forget to hit the like and subscribe buttons down below, because in part 4, we're going to cover how to choose a new home that you'll absolutely love. I'll leave my contact details down in the description below, so if you have any questions at all, please feel free to reach out. I look forward to hearing from you.